Hi everyone, I'm Roy Gillolo. Welcome back to the another episode of Market Update featuring by Rationale and Marketsall. This week I'd like to start with covering last week the CPI data that we received last week. But before that, I'll get into the survey that is done through Bloomberg Terminal to the institutional investors for the potential scenarios of US election and the impact of that outcome of the election on stock market and bond market. Let's start with that. Then afterwards, I'll be flipping through a few charts that are important to me. And first of all, here you can see that there are two tables on the left-hand side. This one is for the bond scenario, and this is for the stocks. And for like what happens to bond if Harris wins, and what happens to bonds if Trump wins. As you can see, if Harris wins, the institutional investors like that they'll be doing nothing. But for the case of Trump, you can see that they'll be reducing bond exposure. I'll explain the mechanism behind it. On the stock side, you can see that they're adding equity risk if Trump wins. That's the, I think, boldest outcome of this survey. But in general, like we can say that for both presidential candidates are looking to increase federal borrowing, but Trump's plan compared to Harris' plan is making this 2017 tax cuts permanent, which could increase the debt to GDP ratio of U.S. government to, according to Bloomberg, 142% over the next decade. So this number is above 20% higher than the World War II period, and that's why it's too much debt for government. And in such scenario, what would happen? Much more Treasury issuing gold would increase the supply of Treasury notes, Treasuries, and that would decrease the bond prices, which would lead to increase in higher yields. So that's on the fiscal side, the impact of bond market is like this. So I was questioning if in such environment, with an increasing yields in Trump scenario, how also they are evaluating stock market to perform better. That's the part that I'm questioning right now. But yeah, in general, like okay, that's like a lower yields tends to due to valuation, tends to. Generally is the reason to see higher stock performance, but it's not the case always. Maybe they have that kind of mentality behind it. But yeah, that's in general. I think the boldest part here that we need to consider is in the case for Trump, the impact of bond market is the potential impact is, I think, much more clear, as he's gonna compensate this the money that is needed through arising from those tax cuts through much more federal borrowing, and which will lead to excess supply of treasuries, and which will push yields higher and worse bond performance. I think that's the part that we need to be careful. And I want to skip to CPI number details. CPI number, I'm not going to get into getting into details of the numbers. Like as you might all know, that it came a little bit higher than the expectation, but it wasn't that much impact, like effective, that would change Fed scenario of increasing 25 basis points in November and December. But now, like lately, like this debate that if the inflation becoming the main focus again compared to the economic activity side, but like I don't think that's the case for now, and I'll show it through also from macro side and through a chart. First of all, this Atlanta Federal Reserve Bank of Atlanta sticky price consumer index. As you can see, in August and September we see a slight rise, but as you can see, like this was the part of the inflationary pressure region, and we're not there yet. I mean, and like this downtrend is still ongoing. These potential spikes are highly possible. Here you can see the break-even inflation rate, which is pushing higher also. This like a 10-year yields are going high. That was one of the reason of main concern. Like currently is long-term end of the yield curve is rising much like higher than the short end of the yield curve, which is actually normalization. That was something that was expected as the yield curve was inverted for a while, and that was the main reason that people were expecting recession is coming. But I mean, in order to get back to the like normal yield curve, this should this is a must. We need to see higher long end yield curves and lower short end of the yield curve. And here you can see sticky price consumer index. Sorry, I showed this one. Another measure that Fed is also taking into consideration a lot is the Federal Reserve Bank of Cleveland. As you can see, here is another spike, but it's not that crucial. Still, the downtrend is intact. Another one, trimmed mean PCE inflation. This is a measure that taking the outliers of inflation components out, and it gives you a more clear picture to at least to see the current situation of the inflation and as you can see, when you come to the shorter term, here it's not like the September number not released yet, but the downtrend is intact as well. So about this, I tweeted about this yesterday. I'd like to show you that here, for those like wondering if inflation is coming back an issue again, like due to like a long-term yields are like after CPI and the non-farm payroll data that came unexpectedly much higher than we expected, and with recent like data and price action, this discussion increased a lot. For that, like in order to like macro side, as I told you, like still the downtrend is still intact in the inflation. Plus, it was just only one data. I mean, I don't see any like this like trend, like downtrend is not disrupted yet. It's still there. That's why I need, at least in order to say such bold comment like, okay, this 25 basis point rate cut for September might be skipped kind of mentality is so early, I think. And I'm following this through this like a long-term bond prices, and there's an ETF, it's called TLT, that I'll be sharing the chart, and I tweeted about that. As you can see, there's a ascending triangle chart pattern is being formed there. So from as this chart goes up, that means the yields are coming down. So I'll show you, I'll come to the technical side, but before coming to the technical side, from a macro perspective, I still see the soft landing scenario. That means like 25 basis points rate cut in November and December, still on the base scenario, and this rising yields may present opportunities. And let me switch to the charts. I'd like to show you this TLT. TLT, as I mentioned, is the long-term iShares 20 plus years Treasury Bond ETF. Here is the weekly chart. As you can see, there's a upward trend line, and the price is testing there. And this is like the red line is 40-week moving average. A potential rejection from here is highly possible, I think. And as long as this chart here, you can see this is the tightening, like as this is easing and tightening, and with the Fed like lowering the interest rates, we expect this chart to go up, and technically it is also supported. So this is like a theme, right? In like macro side, we put tick. Technical side, we can put tick. This is a trade idea, for example. You can also do this trade through US yields futures. That's another option. But generally, this is the mentality. And let me show you this on also this 10-year yields chart. Let's check that as well. This is the recent increase. This is 200-day moving average, And as you can see today, we're seeing, while I'm recording this video, we see a rejection from this like around 200-day moving average level. And yeah, I still expect this downtrend to be intact. It's not like that clear, but yeah, you can see that at least it's the downtrend that has started in October 2023. Here you can see the dollar index. Last week I had mentioned this level. I had mentioned that I'm watching this level if we're gonna see rejection from there, but it managed to pass that level, and also it is threatening now the 200-day moving average. Like with the same mentality of the 10-year Treasury yields, I still expect dollar index to trade lower, and this price action is not only like sourced by the higher than expected NFP and CPI number, it's also sourced by geopolitical tension that keep coming, and that's another reason. In euro dollar, maybe still there's an opportunity. As you can see, this symmetrical triangle chart pattern, if you're watching the videos that I keep mentioning this trade, I had mentioned this trade idea before, like buying here with stop and this tail wall, and here it's pulling back around that level, and also this level is like it's around 200-day moving average, and seeing a potential rejection from here is highly possible. My only concern about euro, since I gave this trade idea, it changed a bit. Like, and like for example, this week ECB is expected to cut rate just 25 basis points, but the issue is the economic activity has started to go a little bit worse than the expected. That's why we might potentially see more dovish scenario for ECB. I mean, maybe saying like we might see, it's not right, but at least if they become more dovish, I wouldn't be like, that would be surprising for me. That's what I'm trying to say. And in such scenario, I would be questioning the strength of euro compared to other currencies. That will be my only concern. USDN, since this unwinding carry trade issue, the carry trade theme, we came from 160 level up until 140. We see a rejection from here, 200-day moving average. I think if you also check the CFTC fund positioning on USDN, still there's a like inflow into Japanese yen, and I still believe that like a potential trade idea is building up here. And as you can see, if we see a rejection around here, around these levels, that might lead to head and shoulder head and shoulder top chart formation that might lead like this. Here, let me show you. This is the question mark. Oops. And here's the head side, and here 200-day. That's 200-day moving average level. This level I'll be like watching carefully. Maybe a short position around here. I don't know. That will be, yeah, like something like this might be traded, or yeah. And gold, still like nothing to say new. Any kind of correction. I mean, that's something that I keep repeating, that any kind of correction is a buying opportunity, and it's provided that opportunity last week actually. Here you can see this move with that after NFP and CPI, with that, like we see the dollar index gained momentum, and with that momentum we saw that gold came here. Then we saw a positive reaction. Today and yesterday it wasn't that much powerful. With, I think also like here this increase, we owe that to some like geopolitical tensions as well. So currently, what are the main factors that are decisive on market prices? Random geopolitical factors. NFP number is the most important one. And this week we're going to receive retail sales data that should, I mean, if it comes really, if it comes like above expectation, that would support the that unexpectedly good NFP number. But if it comes lower than expected, then we'll be questioning that unexpectedly good NFP number, because the main trend was downtrend for NFP. And if we see, that's why this retail sales data will be pretty important. If we see like lower than expected data, that will mean okay, that NFP number just like just one-time thing, and still like bad data, bad pricing, good data, good pricing, we're still there. But that will mean that if we see like lower than expected retail sales data, 25 basis point will be certain. And here S&P, I had mentioned this, that I'm following this chart. As long as like for the yield, as long as yields come down, we can say that that long duration assets like more like growth stocks, tech stocks, like the valuation wise, and those might perform well. Apart from that, we're in the like Q3 earnings season, and that will be highly influential. On average, I think it's 7% EPS growth is expected according to FactSet, and it was 11% in the Q2. As long as we don't see any surprise, I think this momentum will be protected, and we might see potential corrections on indices. I don't know, like last week video, I was mentioning we were here actually while I was recording that video. We were here, and I was expected that potential head and shoulder continuation might be formed here. This was also supported by the macro side, because with the yields coming down, the like small stocks also would be like benefiting with that lower yields. And with that expectation and seeing such formation, I was expecting this to happen. And then as you can see, now we're here. I think we can take this question mark out, and we can call this head and shoulder continuation after a breakout from weekly chart. This is, I think, this trade is part of this generalization of the momentum in the like large cap stocks, because like like big stocks did perform really well, but we didn't see that impact on like small cap ones or medium caps equities that much. And this is the way that I'm following if that scenario is happening or not. And here's Stoxx 600 European. Here is also a head and shoulder continuation chart pattern. It's like pretty normal to see a potential rejection from this area. We see a breakout that might be a good opportunity. DAX, we had mentioned last week, we were here like a potential pullback scenario, and now we're here. This trade idea performed really well as well. And I would like to touch lastly Bitcoin USD, and currently we're trading around 66k levels. In the big picture, I'm following this cup with handle chart pattern, and as you can see, when you come to the daily chart, here's the ascending triangle, and now like this level, this resistance is being forced. Like I don't see any like downside for cryptos as well. And I'm still like, I can say that with the base scenario of soft landing, I still see that there's a room to go for cryptos. That's why, like, that's how I'm following this one. This as first of all ascending triangle chart pattern, then a potential breakout of this weekly cup with handle. And yeah, that's all I'm going to talk about this week. Thanks for watching. If you find like valuable, if you find beneficial whatever you watch here, please give it a thumbs up, subscribe, open your notification for our videos. That means a lot to us. And I hope you all like a great week and happy trading.